That's what they want. They want a central bank digital currency. Or do we go back to constitutional sound money? Do they revalue gold? Do they have a Bitcoin strategic account and revalue gold and have assets that allow them to create a new monetary system based off of commodities with a marriage of blockchain technology? Maybe. I don't know that that'll happen, but what I do know will happen is that we are seeing more and more and more de-dollarization, and they're moving in that direction, at least in terms of de-dollarization. The global net purchases by central banks reached 53 tons in November. That's the most in 14 months, and it's the 18th consecutive month that the central banks have purchased gold. They have doubled in November their 12-month moving average.
In today's news recap, UBS stays bullish on gold for 2025 as central banks fuel demand surge. UBS predicts gold's 2025 rally could defy rate cuts and a strong dollar, fueled by central bank demand and economic uncertainty. UBS, the Swiss multinational investment bank and financial services giant, has offered an optimistic outlook on gold for 2025, despite the metal losing some momentum in December following the U.S. Federal Reserve's hawkish stance during its policy meeting. In 2024, gold surged by 27.6%, marking one of its strongest annual performances in over a decade and surpassing the S&P 500's returns. While the Fed's tone caused short-term headwinds, UBS analysts remain confident that gold's upward trajectory can continue into the new year, supported by structural economic factors and ongoing central bank demand. We believe gold can build on its 2024 gains. Although U.S. rates may fall less than expected, they are still on track to decline. UBS's chief investment office highlighted central banks' significant role in driving gold demand. The forecast reflects increasing diversification and de-dollarization trends among global central banks. Despite potential challenges, including fewer anticipated rate cuts and a stronger U.S. dollar, UBS maintained a positive stance. Reflecting the shifting economic environment, UBS lowered its 2025 gold price forecast by $50 per ounce. The bank now projects gold will reach $2,850 an ounce by the end of 2025, down from its previous estimate. Despite this downward adjustment, gold was trading at $2,639 per ounce as of last week, indicating UBS still expects the metal to rise, albeit at a slower pace than initially anticipated. Before we dive into the best clips of the week, don't forget to smash that subscribe button and check out our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest, most reliable service to secure your data and keep prying eyes away. Plus, if you're a stacker looking for truly independent market insights, visit goldsilverstacks.com for the Stacker's Handbook, a comprehensive guide packed with strategies to safeguard your financial future and take control of your wealth. And by popular demand, we've launched our print-on-demand gear for gold and silver stackers. From stylish apparel to unique stacker-themed accessories, it's the perfect way to represent your passion for precious metals. Premium quality, shipping worldwide. Enjoy the episode.
Certainly inflation, we all know what that should do for precious metals prices. Trump is even talking about putting tariffs on metal that comes into the United States, which this is one of the reasons you're seeing, again, this big spread between the exchange for physical price and the spot price. Where if you have to exchange it for physical across the globe, it's going to be a whole lot more expensive right now, fearing these tariffs. In other words, if they wanted to buy a contract here and exchange it for physical and take it back to the United States, the premiums have blown out because the fear is that once he takes office, he'll put tariffs on precious metals imports as well, which would push the price up tremendously. Inflation, obviously, the price should go much, much higher, and that's really what the whole premise of owning gold is. It's in silver. It's not that gold and silver are going higher. It's that the dollar is being inflated out from underneath us. I asked Judy Shelton the other day in my interview with her, I said, who came up with this boneheaded idea of a 2% mandate? Why not zero? Because with a 2% mandate in 10 years, you've lost 20%. I said, my father I'm sorry, this little dog is insane and she's all over the place. He graduated college in 63. He was married at that point, my mother, and he said, I made $6,500 a year and I could live comfortably on that. Your mom and I could live comfortable on that in 1963. So, have things gotten that much more expensive, or has the dollar lost that much of its purchasing power? So when we look at you look at, imagine this was real. This is fake. It's a bank. But imagine a COMEX 100-ounce gold bar in 1974 when the exchange was founded. Gold was $42 an ounce. So, 42. It would have cost you for a 400-ounce gold bar like $14,000 to buy a 400-ounce gold bar in 1974. Well, what does it cost today? Is the price of gold go that much higher to where it's almost 1.2 million dollars? Or did the dollar lose that much of its purchasing power since 1974? My dad bought a Corvette in 1973 for $6,500, a Corvette Stingray. Now they're 116. The point of it is that over time, inflation is an insidious tax on your wealth. And so what gold does is it doesn't go higher. It retains its value in an inflationary environment. And everything Trump is talking about is inflationary, whether it be tariffs, which will mean higher prices to the consumer, or whether it be an inflationary policy, a weakened dollar, low interest rates. These all mean softer purchasing power. So I would say inflation is here, and you can see that the bond market sees that. That's why rates are going higher. And with all things being equal, even if they are able to trim $2 trillion off the deficit and off of the stupid spending of the government, that still leaves over a $1 trillion deficit every year. We're not addressing the root problem, and that is the fact that the deficit keeps adding to the debt. And, by 2031, 100% of income tax revenue, according to the Congressional Budget Office, goes to pay the interest on the debt and mandatory entitlements, which ironically are off balance sheet. Social Security and Medicaid and Medicare, he won't touch those. He already said that. So, inflation has to stay here because no one wants our treasuries at these rates. So if rates, and that means rates have to go higher. That hurts the economy. That hurts the banks. And if not, that means yield curve control. That means printing money out of thin air to buy bonds. That's Weimar Republic. That all leads to the same road. And, who knows when this all happens? They've been masterful at being able to keep the ball up in the air. But speaking, just speaking practically, at some point, the jig is up. So, yeah, for the people who are retiring right now, I don't know. I would be more concerned about their kids, people our age who, things may be a little bit different over the next 5, 6 years. Yeah, there is certainly reason to be optimistic, but we're talking a long road to hoe to bring back manufacturing, to bring back the things that made this country great. And to get there, it's going to take maybe a reset, and short of that, a whole lot of debt restructuring, which is not going to be easy. It's going to be painful. So,
in today's news recap, gold jitters. According to our gold return attribution model, the primary driver for gold's decline was a strong rally in the U.S. dollar index, which finished the year at its high. Softening gold's drop were a rise in break-even inflation expectations and the geopolitical risk index, likely on the back of martial law declared in South Korea, as well as small global gold ETF inflows. Global gold ETFs eked a U.S. $778 million gain in flows thanks to strong Asian ETF buying, significantly offsetting outflows in North America during December. Those outflows were quite benign given the weakness in November and the prospect of profit taking following such a strong year. A positive sell-side outlook for gold probably helped constrain a bigger end-of-year shift out of gold. Bonds are set to stay on shaky ground, and this should help gold at the margin short term. Gold may need to consolidate in Q1 2025 as technical signal that it resides in overbought territory. Additionally, Fed puts punch bowl back in the fridge. A 25 basis points Fed policy rate cut in December, doused with further hawkish guidance, resulted in sizable intraday wobbles in equities, U.S. Treasuries, and gold. The S&P 500 fell by 3%, and the 10-year Treasury yield marked the largest FOMC meeting move since 2013. Gold dropped by over 2%. Undoubtedly, the Fed's sober messaging prompted some investors to take profit following a stellar year for equities and gold, with tax law selling an additional incentive to cut equity exposure. A high rate of uncertainty. The reaction probably also reflected some pent-up uncertainty that markets, as well as the Fed, soon face a change in personnel at the helm of the U.S. economy come January 20th. While the FOMC members are somewhat confident in where interest rates will be at the end of 2025, they are unusually divided on where rates will be at the end of this cutting cycle.
When I follow who's been buying gold, I look to the central banks. When I see what's going on in the stock market, I see the insiders selling at a 6-to-1 clip versus buying. In other words, corporate insiders are, for every one purchase, there's 6 sales. And you look at guys like Bezos, who sold 12.5 billion recently, Zuckerberg, who sold 2.5 billion worth of Meta. You look at the Nvidia insiders selling over 2 billion worth of sales. This is all year to date, but just between Zuckerberg and Bezos alone, you're at $15 billion sold. And, you know, if the economy was roaring and we would expect the stock market to continue on this massive train moving forward, you wouldn't see that happening. And so as corporate execs are cashing out, individual investors aren't. That's a premise that I would start with, that I would be very nervous. I think we can look at the bond market, which in and of itself is getting nervous as inflation concerns are again reemerging, and they really never left. I mean, the Fed pivoted at 65-70% away from their lofty target rate. Was making a joke about this the other day. You're taking a cross-country trip from California to New York, and you stop in Omaha and say, we're there. We're 70% of the way there, but that's okay. That's good enough. And the point of it is that they haven't signaled victory on inflation. They've waved the white flag on it. And we can see that happening as the 10-year Treasury keeps going higher. In fact, the 20-year Treasury, which is something we really don't talk about very often, eclipsed 5% here just the other day. That's a big deal. That's a problem. We're getting into that point where the economy is going to start to shake and rattle, and we're seeing that with all of the longer duration maturities. And so, what does that mean for the economy? What does that mean for the bond market, for the ballooning U.S. debt? And what does it say about the flood of new Treasury securities that the government's going to have to sell? Who's going to buy them? Does that mean higher rates yet still? Are we in store for a yield curve control, which will again exacerbate inflation as we create money out of thin air by the Fed to buy the debt because no one else wants to buy the debt? And then you look at all of the metrics by which we gauge, are we heading into a recession, which would negatively impact stock portfolios and whatnot. And by every single metric and then some, we're there. The reinversion or the uninversion of the yield curve, the Claudia Sam rule, the increase in money market holdings, which is up to over $7 trillion. All of these things have accurately predicted recessions in the past. And so if I were at that point where I'm very quickly going to be receiving money out of my retirement, I would not have a problem with pivoting. I would not have a problem with selling all of those stocks in my IRA that I made a lofty profit on. Get the hell out of them, just like the big money is doing, before something happens that forces you to get out. Get out now, and I would layer it into incredibly short duration treasuries. As crazy as that sounds to me, I don't know where else you go where you can feel safe and sleep well at night in a market by every single metric is classically and historically overvalued, and the insiders are bailing ship, and the long end of the bond market moving higher, where the banks who bet again that wouldn't happen are going to be on the wrong side of that bet, especially if rates really start to move higher, which I expect that they will.
What are your thoughts on Andy Schectman's interview? Do you agree with his predictions? Do you think the BRICS nations could challenge the US dollar and disrupt the American economy? Could gold really blow up in 2025? Drop your honest opinions in the comments and let the Stacker community know if you're investing in miners or prefer sticking with physical metals. Thanks for watching. Don't forget to check out this video over here. I'm sure you'll enjoy it. I'll see you on the other side.